Right now, as I speak, SoFi Technologies Inc., ticker symbol SOFI, is trading live at $27.16, up approximately 1.23% on the intraday session. That green figure on your screen might look calm, perhaps even routine for a stock that has seen significant volatility, but do not let that headline number deceive you. What is happening underneath the surface of this price action is a violent recalibration of how Wall Street values modern banking. The expectation right now, the narrative you will see on every message board and financial news ticker, is that SoFi is diluting shareholders again. They see the recent $1.5 billion equity offering, they see the share count expanding, and they assume this is a sign of weakness, a desperate grab for cash to plug holes in a leaking boat. That is the expectation. The reality is far more aggressive and, frankly, terrifying for traditional banks. This capital raise is not a defensive shield. It is an offensive war chest. What you're witnessing at $27 a share is not a company struggling to survive. It is a profitable, chartered bank accumulating the firepower to acquire, expand, and dominate a fragmented fintech landscape that is rapidly consolidating. While the average retail trader worries about a few percentage points of dilution, institutional capital is quietly positioning for a massive repricing event, where SoFi stops being valued as a speculative fintech and starts being valued as a high-growth national bank with the margins of a software company. Let's look at the immediate market mechanics driving today's move. The stock is pushing off a support level established right after the announcement of that $1.5 billion raise. Typically, when a company floods the market with new shares, the price collapses and stays down. SoFi dipped, yes, but look at the recovery. It is resilient. This tells us that the market has arguably digested the dilution and is now focusing on the use of those proceeds. We are seeing volume today that suggests accumulation, big blocks being bought up not by day traders, but by entities with long time horizons. They are looking at the Q3 2025 earnings report, which we will discuss in a moment, and they see a company that has posted its 8th consecutive quarter of GAAP profitability. That is not a fluke. That is a trend. When you compare this price action to the broader sector, the divergence is clear. While many legacy regional banks are struggling with deposit flight and compressing net interest margins, SoFi is actually lowering its cost of funding. How? Because they are not renting their banking charter anymore. They own it. Every time the Federal Reserve adjusts rates in this 2025 economic cycle, SoFi captures more spread than its competitors, who rely on third-party banks. This is the reality that the bearish thesis misses. SoFi is no longer just an app. It is a balance sheet fortress. Let's analyze the recent $1.5 billion equity offering because it is the elephant in the room. The headline read dilution, and the knee-jerk reaction was to sell. But pause and ask yourself, why raise that much cash when you're already profitable? You do not raise $1.5 billion to pay the light bill. You raise it to make a move. The speculation here, and this is where the smart money is focused, is that SoFi is preparing for strategic acquisitions or to aggressively expand its loan book while competitors are pulling back. In a high-interest rate environment, cash is king, and SoFi just crowned itself. The market is starting to realize that this dilution might actually be accretive to earnings per share in the long run, if that capital generates a return on equity of 20% or higher, which is exactly where their financial services segment is trending. This brings us to the macroeconomic backdrop we are navigating in late 2025. The yield curve has been dancing around inversion and normalization, keeping bank investors on edge. However, SoFi has a unique hedge. Unlike a pure-play lender, they have the technology platform, Galileo and Technesis. Think of this as the AWS of fintech. When you look at other players, perhaps you utilize Robinhood stock trading for its sleek interface, or you check your retirement on a Fidelity trading platform. What you might not realize is that the back-end infrastructure powering many neobanks and global fintechs is owned by SoFi. This segment grew largely in the last quarter, proving that even if lending slows down due to macro headwinds, SoFi still gets paid when other people swipe their cards. We need to talk about the earnings because the numbers from October 2025 were a revelation, not in the sense of a miracle, but in the sense of undeniable proof. They reported net revenue of $962 million. That's nearly $1 billion in a single quarter. Net income came in at $139 million. Remember 3 or 4 years ago when the bears screamed that this company would never make a real dollar? They are now generating over $500 million in annualized net income. That silences the cash burn argument permanently. The most impressive metric, however, was the tangible book value per share, which has climbed to nearly $6. When a stock trades at $27 and the tangible book value is rapidly rising to catch up, the downside risk becomes mathematically smaller every single quarter. Now, I want you to take a second and think about your own portfolio. Are you holding this for a quick trade, or are you looking at the 5-year horizon? Comment below how many shares of SoFi Technologies you currently hold, and more importantly, what is your average cost basis? I'm seeing people in the comments who bought at $8 in 2024 and are sitting on massive gains, and others who bought at $25 recently. Let's get a census of where the community stands. Moving back to the analysis, we have to contextualize SoFi against the giants. When you consider online investing or investment help, names like Schwab Intelligent Portfolios or Fidelity often come to mind first. These are entrenched incumbents with trillions in assets. But here's the difference. SoFi is building a financial super app. It's a term that gets thrown around, but look at the execution. You can refinance your student loan, take out a mortgage, buy Tesla stock or Nvidia stock, get a credit card, and bank, all in one ecosystem. Interactive Brokers is fantastic for professional traders, but it doesn't offer that seamless lifestyle integration for the average high earner. SoFi Invest is capturing the Henry demographic, high earner, not rich yet. These are people making $150,000 a year who will be the millionaires of tomorrow. By capturing them now with student loans, SoFi cross-sells them into SoFi ETFs, SoFi robo-advisor products, and eventually wealth management. The cost of customer acquisition is the killer in this industry. If Robinhood wants to sell a mortgage, they have to pay a fortune in marketing to find a borrower. SoFi just sends a push notification to the millions of people already checking their savings account every morning. This productivity loop is finally showing up in the margins. In the last report, the financial services segment, which used to be a money pit, generated record contribution profit. This is the inflection point where the flywheel starts spinning under its own power. Let's discuss the Technisys acquisition because it is often overlooked. Legacy banks run on code written in the 1970s. It's slow, expensive to maintain, and rigid. Technisys allows banks to create new financial products in weeks, not years. By owning this stack, SoFi is not just digging for gold, they are selling shovels to every other bank trying to digitize. Even if you use Fidelity Investments or Fidelity Brokerage Services, the pressure on those firms to modernize their back end to keep up with the speed of SoFi Active Investing is immense. SoFi is setting the pace for the industry's technological standard. However, we must remain objective and look at the risks. The reality check works both ways. The credit quality of their loan book is the primary risk factor. In a severe recession where employment spikes to 6 or 7%, personal loans are the first thing people stop paying. SoFi argues their borrowers are high quality, average FICO scores above 750, and high incomes. But even high earners can lose jobs. We saw a slight uptick in delinquencies in the broader sector this year. SoFi has managed it better than most, maintaining robust charge-off ratios, but it's a metric you must watch like a hawk. If that credit box cracks, the stock will retrace significantly. Another risk is regulatory. We have seen increased scrutiny on bank-fintech partnerships. While SoFi is a bank and less reliant on partners, its Galileo arm serves many fintechs that are under the microscope. If the regulatory environment tightens on Robinhood crypto offerings or if capital requirements for digital banks are raised, it could dampen the return on equity. But again, SoFi's leadership, led by Anthony Noto, has been incredibly proactive here.